The rich are getting richer and the poor are getting poorer. The numbers don't lie, and today I'm going to break down the who, the what, and the why of income inequality. I'm not a financial expert, but I have found some numbers that are very worrying to me and hopefully for you too. The wealth gap is getting wider, and the consequences of this fact might doom us all. I'm Mikel, and this is what I learned today. Wealth inequality simply means that some people have far more money and resources than others. Think of it like a cake. A few people get a huge slices while others get just a few small pieces. For example, in the US, the richest 1% own over half of all stocks and investments. Meanwhile, most people simply depend on their homes and maybe their cars as the biggest financial assets. That is what makes owning a house so important in the middle class. Without stocks and businesses or multiple properties, many people have a very difficult time creating long-term financial security. Wealth inequality is different from income inequality. Income refers to how much money you make each year, while wealth includes everything you own, like savings, investments, and property, minus any debts, money you might owe. Someone could have high income but little wealth if they have a lot of debt, while another person could be very wealthy without earning much because they own very valuable assets. Let's go back a bit. In the 1800s, almost everyone was poor by today's standards. Societies were mostly agrarian, meaning most people worked in farming and economies were local. Then came the Industrial Revolution. Factories, machinery, and new industries created jobs and wealth, but this wealth was not evenly shared. Whilst industrialists and landowners became extremely rich, many workers remained poor, working long hours for low wages. By the early 90s, labor movements and new government policies in many countries helped reduce inequality. Workers fought for better wages, governments introduced social security systems, and some countries like the US and much of Europe introduced progressive taxation, where the rich pay higher taxes. But things changed in the 1980s with Ronald Reagan and what he called trickle-down economic policies, where he believed by cutting taxes for businesses and the rich, the money they save would be reinvested back into the company, and of course, the argument creating more jobs. Many governments started cutting taxes for the very rich, deregulating businesses, and reducing social welfare programs. This allowed the wealthiest people and corporations to accumulate even more wealth. Today, wealth inequality is wider than it has been in decades. To put it into perspective, the Forbes 400 Richest Americans, a magazine that publishes a list of the richest people in the US, back in 1982, the average net worth on that list in today's dollars was $670 million. By 2022, that same list, the minimum to make the list was $2.7 billion, more than 4 times as much. This shows, or a small example of how wealth is increasingly moving towards among the richest few. Globally, the richest 1% control about 47.5% of all the wealth. Meanwhile, nearly 40% of the world's population owns less than 1% of it. Imagine just a couple people at an all-you-can-eat buffet, and all for themselves, a couple people, all you can eat, and while dozens of others have to share a single plate of food. I know it sounds exaggerated, but that's more or less what it means. When it comes to wealth distribution, more than 2/3 or 69% of global wealth is held by developed nations like the United States, Spain, the EU, while less than 1/3 can be found in developing world. The top 1% now own 43% of all global financial assets. Is to say that nearly half of financial assets, houses, stocks, funds, buildings, are owned by a few people. In comparison, the rest of the developed and developing world. Some level of inequality can drive ambition and innovation, which is a good thing. We need to be motivated to make money, to get rich. When people see opportunities to succeed, they work harder, they start businesses and invest in their futures. But when that gap gets too wide, it leads to problems. So, if only a small group holds most of the money, there is less spending by the majority, which can slow down economic growth. Businesses need customers who can afford their products and services. And if wages or salaries remain low while the cost of living rises, demands for goods and services drop, which can lead to economic stagnation, meaning the economy won't grow or the economy will decrease. So if a small group of people have most of the money, that means less money for the rest to invest, and it reduces the buying power of regular people. High inequality is also linked to higher crimes, worse health outcomes, and fewer opportunities for upward mobility, which means to simply continue to move ahead on the social ladder. Studies show that in highly unequal societies, people from poorer backgrounds have a much harder time improving their financial situations, leading to generational poverty. That's why I go back again. This is why having an asset like a house can help future generations in gaining wealth. Why do the rich pay less taxes? Well, one reason inequality grows is how tax systems favor the wealthy, allowing them to pay lower tax rates than ordinary workers. Over the last few decades, tax rates on the rich have fallen globally. Let's go back. In the 1950s, the US taxed top earners over 90%. Today, 37%. In the UK, it reduced highest tax rates from 83% in the 1970s to just 45%. Germany's rate also dropped from 56% to 45%. These cuts overwhelmingly benefit billionaires and multimillionaires, which means less money for government spending in social programs like healthcare and education. In other words, regular people spending more money or using credit to get basic services, which leads them to debt and eventually poverty. In the US, the number one reason why people go into bankruptcy is due to medical debt. Yes. The rich earn most of their money from investments, stock, real estate, and businesses, rather than salaries. Since investment income is taxed at a lower rate than wages, the ultra-wealthy legally pay less taxes. For instance, the U.S. tax capital gains is just at 20%, while a country like Spain has a capital tax gain of 26% after a profit of 600,000 euros. Let me just quickly explain. I know these are a lot of numbers. It just simply means that if you invest in a company, let's say you invest in Apple, and that money isn't taxed until you cash in, meaning when you go and you try to cash the stock, meaning you sell, and that money that you get in, that's the money they're talking about. In any investment, you have a home, you have stock, bonds, funds. When you cash in, that's when the money is taxed. So simply means that you can keep your money in these financial assets for the rest of your life and never pay taxes on them. So here's another topic to talk about. Let's talk about loopholes. What are loopholes? These are just small gaps in the rules that allow the rich to pay or to abuse the laws for their own benefit. Short tax savings are places where the rich pay really low taxes or no taxes at all, and shell companies or fake companies that big businesses use to hide their money. The wealthy protect an estimated 8.7 trillion from taxation. I'm sure you've heard of these scandals like the Panama Papers in 2016 and Paradise Papers in 2017 expose how billionaires and companies, including Apple, Nike, move profits to low tax paying countries, costing governments, which in turn forces governments to increase taxes on everyday people, which reduces the wealth of the people and their spending power. It's all connected. Corporations also pay far less than before. In the 1950, corporate tax made up 30% of U.S. federal revenue. In the 1950, corporate tax, the money that the government got from businesses, made up 30% of the government's revenue, the money that they receive. And today, that number is 10%. Major companies, they use tactics like profit shifting, meaning moving profits to low tax countries like Ireland and Switzerland, or tax evasion, meaning relocating their headquarters like Google did, right? Google headquarters was in the United States, and Google moved their headquarters to, guess where? Ireland. Why? They pay less taxes there. Deductions and credits, I'm not going to get into all of that, but it's a lot, all right? There are many tactics, and others are currently being used by everyday developed and developed nations. As the wealthy continue to hold more and more of the world's wealth, we will continue to see reductions in government spending on social programs, leading to poorer quality in services. Now, while many nations lower taxes for the wealthy, some ensure fairer contributions. For example, Sweden, high taxes fund free healthcare and education, reducing poverty. Norway, high wealth taxes to prevent excessive accumulation. Denmark, they have a top tax rate of 55.9%. High living standards. South Korea has a 50% inheritance so that there isn't wealth concentration, right? If you tax the wealthy enough, they won't give their children to their other children, to their other children, so on and so forth. Countries with strong taxation on the rich tend to have lower inequality and better public services, while those who cut taxes for the wealthy often see rising deficits and greater wealth gaps. Can we reduce inequality? Well, there are a couple possible solutions. The obvious one is the wealthy. Taxing extreme wealth to fund education, healthcare, and social programs. Higher minimum wage. Increase salaries for working class people. Some even have suggested UBI, or Universal Basic Income, meaning the government gives everyone a set of money and they receive this money every month. And stronger labor rights. Give the power to the people to negotiate their wages better with businesses. Here are my final thoughts. I believe you should be paid what you deserve. If you work hard, you should get paid what you deserve. If you took the time to educate yourself, you should get paid what you deserve. But if I'm putting in this effort and I see my wages stay the same while the rich become richer and my buying power is getting weaker, when I see inflation go up and my salary stays the same, and I see the rich getting richer and I'm getting poor even though I'm doing everything I can, it would appear that the game has changed and I am playing at a disadvantage. I want everyone to pay their fair share, and that includes the mega rich. I am not a fan of taxation, but I see the wonderful things it does for those who are in the bottom half of the economy. It improves the lives of so many people. It gives people a chance to survive. Elon Musk and others can afford to pay $1 billion a year, and it's time they did so. I hope that you found this episode insightful. Please like if you do, subscribe if you haven't, and share with your friends to keep this message going. We need to close the gap of wealth inequality. I hope you learned something. I learned something too. I'm Mikel, and this is what I learned today. Bye.